Hello, welcome to this session. In today's session, you will learn about major financial or market participants and their functions. So, who are the key players in a financial system? Financial or market participants include issuers, investors, brokers and dealers, depositories, custodians, registrars, lead managers, and depository participants. These participants play a pivotal and active role in the financial market. The participants of the financial market are mainly those who have surplus of funds and those who have deficiency of funds. Individuals or entities who have surplus money invest in the financial market in the hope of getting high returns on their investment compared to other form of investments like real estate or a bank savings account. On the other hand, people with deficit of funds try to get financing from the financial markets by either selling stocks and bonds or borrowing from financial institutes at higher rates. These two kinds of activities keep the financial markets going. In the diagram, we have buy side, that is investors who have surplus funds and buy stocks or bonds to gain more profits. On the other side, we have the sell side, the organizations, individuals in need of funds. They sell their stocks or issue bonds or pay interest to raise funds. The buying and selling of equity shares and bonds is done through an exchange, and thus they become an important participants in the financial market. We have covered first the active participants in this session, namely issuers and investors. The other participants and also the major participants include lead managers, broker dealers, depositories, depository participants, clearing agents, custodians, and registrars. All these participants will be covered in the next section. An issuer is a legal entity that are in need of funds for growth or expansion of its operations, and hence they develop, take approval from regulators, and hence go through the registration process of the securities and sell securities for financing its operations. Issuers are legally responsible for obligations of the issue. This means they are supposed to report their financial conditions and disclose material developments affecting their overall performance. They are also responsible for any other operational activities as required by the regulations of their jurisdictions. In case the issuer is raising debt, they have the obligation to pay interest and refund the loan taken. However, if funds are raised through issuance of equity shares, then there is no need to repay the funds to the investors. Issuers can be domestic or foreign. They can be governments, corporations, investment trusts. Issuers belong to the demand side of the process. The demand side consists of those in need of cash flows, that is, daily operational needs. Those in need of interim financing, that is, bridge financing. And those in need of long-term funds for special projects, that is, capital funds for venture financing. An investor is an individual or institution who puts money to buy securities in expectation of profitable returns as interest, income, or appreciation in value, that is, capital gains. An investor investing in equity shares relies on fundamental analysis, market information, and technical analysis for his investment decisions and expects capital appreciation on his investments. Let's begin with lead managers. They are independent financial institutions appointed by the company planning to go public to manage their IPO. Lead managers are responsible for most of the IPO processing. In the pre-issue process, the lead manager takes up the due diligence of the company's operations, management, business plans, legal matters, and also helps in obtaining required regulatory approvals. The lead manager is selected to manage key aspects of an equity issue, including organizing syndication of underwriters and ensuring efficient distribution of the offer. Lead managers becomes the face of the issuing company during its IPO. Lead managers are also known as book runners, underwriters, merchant bankers, and investment bankers. The issuer company can appoint more than one lead manager to manage big IPOs. For example, the Reliance Power IPO came in Jan 2008, had 10 book running lead managers. Chief functions of lead managers are drafting and designing of offer documents, prospectus, statutory advertisements, and memorandum containing salient features of the prospectus. Writing the red herring prospectus and getting it approved by SEBI. Assisting the company in the sale of IPO shares or raising funds for the company. Finalize the issue price, issue opening and closing dates, listing date, etc. Managing the post-issue activities, including management of escrow accounts, coordinating non-institutional allocation, intimation of allocation, and dispatch of refunds to bidders, etc. along with finalization of trading and dealing of instruments and dispatch of certificates and demat of delivery of shares with the various agencies involved. Now let's take a look at brokers and dealers. On a screen, the diagram highlights the structure of the financial industry. The regulatory bodies, Securities Exchange Board of India, or the Security Exchange Commission in the USA are at the base. Thereafter, the regulatory bodies appoint stock exchanges, Bombay Stock Exchange or National Stock Exchange in India, and New York Stock Exchange or NASDAQ in the USA. to regulate the operations of brokers and dealers. Independent broker dealers are the next level within the industry. They act as a liaison between regulatory bodies and the registered representatives. That is the members that are licensed to sell securities. Essentially, a broker dealer is the catalyst for financial transactions. Their oversight is needed to protect individuals from fraudulent activity, and their access gives financial advisors a portal to work with investors' money. In other words, the broker or dealer is a silent player in an investor's activities. Broker dealers are engaged in the business of trading securities for their own account or on behalf of their customers. These brokers could be individuals, a company, or other organizations. When executing trade orders on behalf of a customer, client, the institution is said to be acting as a broker or agent. When executing trade orders from their own investments, the institution is said to be acting as a dealer or principal. Functions of broker dealers are provide advisory and investment management services to investors, that is, the purchase or sale of equity shares, bonds, mutual funds, etc. Publish research reports for their clients on economy, industry, or company. This can also include providing commentary and recommendations on the money market and bonds instruments, commodity, real estate, etc. Execute buy or sell orders on behalf of their clients in the stock exchange, settlement of trades, transfer of shares or funds to the investor, liaison with stock exchange for settlement of trades, margin money, etc. Many brokers or dealers distribute other financial products such as mutual funds, real estate, private equity funds, bonds, insurance, etc. Depository is a specialized financial organization that holds securities such as shares in either certificate or an electronic form, which is also called dematerialized form. The goal is easy transfer of ownership through a book entry rather than the transfer of physical certificates. Suppose an investor wants to sell his shares and has placed an order which has been successfully executed on the exchange. It is depository's responsibility to change the ownership on the share certificate, whether physical or dematerialized format. Obviously, change of ownership will happen on the receipt of proper instructions from the investor. The depository system functions very much like the banking system. A bank holds funds in accounts, whereas a depository holds securities in accounts for its clients. A bank transfers funds between accounts, whereas depository transfers securities between accounts. In both systems, the transfer of funds or securities happen without the actual handling of funds or securities. Both the bank and the depository are accountable for the safekeeping of the funds and securities respectively. In the above diagram, the investor provides instructions to the depository to transfer its shares held in the dematerialized form, and the depositories would execute the transfer held by them in the electronic form. Clearing and settlement done An electronic form helps execute the transaction faster than that was done traditionally, where physical certificates had to be exchanged after a trade had been completed. Depositories can be national or international in nature and maybe for a specific type of security. International central securities depositories include Clearstream, which was earlier known as CIDEL, Euroclear, and 6sys, and US Depository Trust Company, also called as DTC. Moving on to clearing agents. A clearing agent is a financial institution that provides clearing and settlement services for financial and commodities derivatives and securities transactions. In the depicted diagram, the seller wants to sell the securities against cash, and there is a buyer in the market willing to pay securities at the quoted price. The two investors in the picture will not do the physical end-to-end settlement. That is the clearing agent's role. To get the securities transferred from seller's name to buyer's name simultaneously without any delay is the clearing agent's job. The cash first gets transferred from the buyer's account to the clearing agent and thereon to the seller's account. Transactions undertaken may be executed on futures exchange or securities exchange, as well as off exchange in over-the-counter market. The executed trade can be handed over to a clearing house, which then steps in between the two original traders' clearing firms and assumes the legal counterparty risk for the trade. It is a common link between the clearing firms of two investors. As per the diagram, the clearing house will assume the role of a seller for the buyer and become the buyer for the seller. This helps to reduce the overall turnaround time and also to maintain the confidentiality of the clients. This process of transferring the trade title to the clearing house is called novation. As per the diagram, the clearing house will assume the role of a seller for the buyer and become the buyer for the seller. This helps to reduce overall turnaround time and also maintain the confidentiality of the clients. In the United States, stock clearing can be done by the Depository Trust and Clearing Corporation or Fedwire. In Europe, securities clearing is offered by EMCF, European Multilateral Clearing Facility, LCH, London Clearing House, ClearNet, 6x Clear, and Euro CCP, Central Clearing Counterparty. Next, we come to the trustee. A trustee is required when a bond is to be issued. It is of paramount importance to set out the contractual obligations of the borrowers and lenders, which is constituted in a document called trust deed. Once the issuer has decided to issue bonds, a trustee is appointed. A trustee could be a commercial bank or trust company. It acts as a mediator between the issuer and investor. The trustee absorbs the bond issuer's duties and risks as well. A trustee sees that bond interest payments are made as scheduled and protects the interest of the bondholders if the issuer defaults. The trustee efficiently performs its duties and complies with the various federal, state, and bond issue requirements. A trust deed usually contains, among other information, assets to be pledged as security, restrictions imposed on the borrower, usually referred to as covenant, principal repayment terms, creditors' protection with regard to future additional borrowing by borrower, rights of creditors in case of default, interest payment terms, coupon rate and when payable, and bondholder details, who are many and dispersed. Hence, a trustee is appointed to protect and enforce the rights of the bondholders as contained in the trust deed. So, what does a registrar do? A registrar is an institution or organization that is responsible for keeping records of bondholders and shareholders. The registrar is responsible for tallying and analyzing the applications. They execute the procedures decided upon for provisional allotment for submission to the issuing house. Upon confirmation of the clearance of the allotment proposal by SEC or SEBI or the governing body in place, the registrar sends out the stock certificates to successful investors. Finally, they verify ownership in the dematerialization process. A final set of participants are custodians. Custodians are banks or specialized financial institutes responsible for safeguarding a firm or individual's financial assets. A custodian is not necessarily engaged in traditional, commercial, or consumer retail banking. Custodian banks are often referred to as global custodians if they safe keep assets for their clients in multiple jurisdictions around the world. This is done by using their local branches or other local custodians with which they contracted to be in their global network to hold accounts for the respective clients. Assets held in such a manner are typically owned by larger institutional firms. That's it for now. Thank you and goodbye.